Welcome back to this series on hedged option portfolios. Apologies for the extra long break. I was busy with other things over the summer and there just wasn't much of interest happening in the accounts, but I'm back at it now. You can see over the summer we did actually set a new all-time high, but it wasn't particularly eventful, surprisingly. As it's been a while, let's start with a quick recap of where the two accounts are at. The main account has been slowly increasing equity via some very small positions over the summer, usually selling the 2-day options and rolling into weeklies when necessary and when vol has been too low in the dailies, all while continuing to hold the longer dated protection. As you can see on the Greeks Live social page, the magnitude of the equity fluctuation has been very small over the summer, but it's at least going in the right direction. So a quiet but positive summer. You may remember this account started with an equity of 0.25 Bitcoin, which was worth $9,250 at the time. The equity is now just over 0.304, which is currently worth over $34,000. I'm in the second account now, and in this second account, currently called the Delta Hedged account, I haven't been trading as much over the summer. Implied volatility was very low, and Delta Hedging was not performing particularly well, so I simply sat with no positions in this account for most of the summer. I'm now going to change up what I do in this second account for a while. Just bear with me for a couple of minutes while I explain what's changing in this account, and then I'll place some trades in both accounts. So far I've used this second account to focus on how delta hedging can be used to hedge option positions, rather than the strategy in the main account of using other options to hedge. The shorter dated positions in both accounts have been very similar, and it's mainly been the hedging strategy that has really set them apart. Now I'm also going to use the second account to highlight a new product type that came to Deribit over the summer: the linear options for Bitcoin and Ethereum. These are options that use USDC as the settlement currency instead of the coin itself, such as Bitcoin. I'm going to be using USDC as the collateral in this account for the time being, so I'll transfer the Bitcoin that is currently in here to one of my other accounts. I originally deposited 0.1 Bitcoin into this account, and the equity at the moment is 0.1015. So just to mark the performance as we're going, it's up 1.5% from the starting amount, in Bitcoin terms at least. In the transaction log with USDC selected, we can see the transfer of 10,000 USDC into the account on the 27th of August. I haven't placed any new trades yet, but as there was a positive USDC equity for the last few days of August, there is a small USDC rewards payment of $4.38. Eligible users holding USDC in their Deribit accounts receive rewards monthly, currently at a rate of just under 4% a year. So that should serve as a nice little tailwind for the account each month. Now I'll head back to the option chain, but I'm going to head to the option chain for the new linear version of the Bitcoin options. And now on the chain for the new BTC USDC options. These are similar to the inverse Bitcoin options, which are also still available, except they are priced and settled in USDC instead of Bitcoin. So these option prices that are showing here all over the option chain are amounts of USDC. As someone who holds Bitcoin long-term anyway, I do like using the inverse options, by which I mean the Bitcoin settled ones, because I can use the Bitcoin I'm already holding as collateral, and indeed that's what I will continue to do in the main account. However, there are quite a few reasons to use these new USDC settled options as well. These reasons will crop up naturally as I begin placing trades in this account anyway, but just to briefly list them, the USDC settled options benefit from smaller minimum trade sizes. The minimum trade size on these Bitcoin linear options is 0.01 Bitcoin rather than 0.1 on the inverse. They also benefit from slightly smaller tick sizes, about half that of the inverse currently, based on current exchange rates. They are more similar to traditional options, which you could view as a positive or a negative depending on your point of view, but it does mean simpler profit and loss calculations. A cash secured put now becomes a simpler position on these linear options, but on the flip side of that, a covered call is simpler using the inverse options. As I mentioned, as we'll be holding USDC as the collateral, we will get monthly rewards in USDC based on the equity we've been holding over the month. And as I'm holding USDC in this account now, it's easier to trade multiple currencies using that same pool of collateral. So I can trade, for example, the linear options for Bitcoin, Ethereum, and Solana, all using the same pool of USDC collateral. And that avoids the negative equity fees of doing the same thing using cross-collateral and the inverse products. However, when using USDC as collateral, there's also no natural long built in from holding the asset. which you could view as a disadvantage if you are bullish that asset long term. And you also have to be aware of the additional risk that a significant depeg of USDC would expose positions to. Now, you might view this as a very unlikely event, and by a depeg of USDC, I mean it loses its peg to $1. So, for example, it could become worth 80 cents, and that would affect how the settlements of the instruments would happen. So you might view that as a very unlikely event, but were it to happen, it could result in settlements being worth considerably more or less than those on the equivalent inverse options. So it's worth at least being aware of that. That's enough explaining for now, though. Let's place some trades. Firstly, I'm back in the main account now, and I'll be doing the same as usual. I'm already long some longer dated options as protection, and I do have one small short that's basically worthless at the moment. So what I need to do in this account is sell some shorter dated options. And remember, in this main account, I'm still using the Bitcoin settled Bitcoin options, so the inverse version. I like to keep the delta in this account slightly positive, and it's slightly negative at the moment, so I'm going to lean into some slightly positive delta in whatever options I choose to trade now. I'm trading the 14th of September options, and I'm going to try and short this 14K put. Enter a price of 80 basis points. And I'll also go for this 115K call. And I'll go for 55 basis points here. There we go. I've got filled on the call side now, so I'm going to change the price of the put order down to 75 basis points. And there we go. I've got filled on both. So I'm short a call and a put on the 14th of September. And you can see my delta has increased from -1 up to 0. It's not quite positive, but it's fine for now. So over to the second account. I'm in the second account now, but I want to trade the linear version of the option. So I'm going to go up to the menu and select the linear options here. Go to the 14th as well. Now, these options are newer, these markets. So I'm expecting liquidity to be slightly worse at least. I would expect to get filled in the middle less than on the inverse options, which are obviously very well established by now. But we'll see how that goes as I place trades here. So I'm on the option chain for the USDC settled Bitcoin options here. So all these prices we're seeing are amounts of USDC. And as the minimum trade size is lower on these options, it's 0.01, I can spread the positions across multiple instruments when I want to. This means the risk won't always be so concentrated on specific strikes and expiries. For now, I will try and sell some of that same option I sold in the other account, although this is the linear version of it, of course. So the 114K put that expires on the 14th of September. Now, I will, of course, try and get filled in the middle here, but we'll see how that goes. And you can see I have the option to trade 0.01 size here. I'm going to increase that a little bit. Let's go up to 0.04 for now. And I'm going to enter an order to sell this at 875 USDC. You can see the mark price has decreased as the underlying price increases a bit. So I might just edit this price to be at least as good as the mark price. So I'll go for 860. And we're not getting filled there, so I'm going to get a little bit more aggressive and see how possible it is to get filled around the middle here somewhere. So I'll go for 850. And the price is moving here, so I will have to edit the price of this quite a bit. So I'm going to drop down to, let's say, 835. The underlying price isn't really helping me out here. It's moving in the wrong direction to get a fill, but I'll edit this down again and chase it a little bit. Edit it down to 820. The underlying price is continuing to move here, so I'm going to have to continue to chase it if I want a fill. Let's go for 795. Having to edit this again, I'll go for down to 780. Basically, I'm trying to figure out if I can get filled without crossing the entire spread here. I don't particularly care about the underlying price moving up or down. I just want to see if people are taking orders that you put in the middle. At the moment, the answer to that is no, but I'll get a little bit more aggressive here and just see if I get filled before I hit this bid. So I'll go 770 for now. At the moment, that's about $40 better than the mark. which on the inverse would be the equivalent of about 4 basis points, very roughly. Now, I have eventually got filled there at 770, but you can see that was not a good fill. The reason I got that fill is simply that the price of the option moved such that the bid moved up to my resting limit order. That wasn't a case of someone taking my well-priced order close to the mark. It was a case of just the bid and ask moving towards where my limit happened to be sitting. So that was poorer execution than I would typically expect on the inverse options at the moment. Like I said, I do expect liquidity to be a bit poor on these while they're still quite new, because you'll have less traders picking orders off in the middle and matching orders closer to mark. But I'll have to be careful with that, because if I execute too far away from the mark too often, obviously I'm just not going to be able to be profitable trading these options at the moment, at least not executing in that way. What I might use as well is the Greeks Live smart trading feature, where I can automatically move my orders and wait for other traders who are willing to execute against my more fairly priced order. And I'll give that a try now. I'll try and sell this 115k call, but I'll do that via the Greeks Live tool. So I'll go to the Greeks Live interface. I'm already in my Delta hedged account, though I'm not Delta hedging at the moment. I'll go to the 14th of September and I'll click Smart Trading and then add a sell order for this, go to next. So I want a dynamic order that changes the price, and I want it to do so based on the mark price, but I'm likely going to have to take a couple of basis points off this. So I'll take 2 basis points off for now, and for the amount I'll go for 0.03. So I'll be slightly leaning positive delta still in the account, and I'll send this order. And back in my Derby account here, you can see that I have now got filled on that order. So we're now short a strangle, 114k put, 115k call, slightly skewed towards having more puts sold. So the delta in the account is slightly positive. And if I scroll down to the bottom, we can see the positions here. Now, unlike previously, I don't have the delta hedger on at the moment. I'll probably start using that again at some point soon. But for now, I'm going to do the same thing I do in the other account, and that's hedge these with some other options. So what I'm going to do is go into one of the longer dates and buy some options. The linear options at the moment only go out 1 quarter. So the longest dated hedge I can do on these USDC settled options is the 26th of December. I can see the spreads actually aren't too bad here, so I might even cross the spread on some of these. So what I'm going to do is first buy some 85k puts. I'll try and get filled in the middle first, because why not? And I'll go with the same size that I've sold. And I haven't got filled there, so I'll just walk that price up to 1150. And I did get a fill there at 1160. I did actually type in 1150, but I've just realized the tick size is 20 when the price is above 1,000. So it'll always round it to the nearest 20. So that's that one done. And on the call side, I'll buy some 160s, and I'll go with the same size as I did on the call side, which was 0.03. And I might as well try and get filled in the middle as well, although I don't expect to get a fill there. Yeah, I didn't get a fill there, so I'm going to have to cross the spread if I want a quick fill here, which I will do like so. And there we go. I got filled at 1140 there. So if I scroll down, you can see I'm now holding some short options that expire in a few days and some longer options that expire in December. So quite similar to the main account, except I'm using the USDC settled Bitcoin options rather than the Bitcoin settled ones. I've only placed Bitcoin trades in this account still today, but in future videos, I will add in some ETH and SOL options to this second account, and then we can see how the USDC collateral helps with managing positions in different currencies. I think that'll do for today though, so thanks for watching and I'll see you next time.